Good day, everyone. We will be reporting about Chapter 4, the internal or company analysis. So, for the Chapter 4 outline, A, review the company's performance in terms of key performance indicators. 1, revenue sales in the past 2 years. 2, applicable financial ratios. Second is do an organizational diagnosis using McKinsey's 7S model. C, from the above, identify the company's major strengths and weaknesses. D, use the IFE matrix to evaluate the overall internal strengths and weaknesses of the company. And lastly, E, summary and conclusion.
Revenue or sales in the past 2 years. Porsche delivered a total of 280,800 automobiles to clients worldwide in its 2019 fiscal year, setting records for sales. Sales revenue increased by 11% to 28.5 billion euros, which is a 10% rise over the same quarter in 2018. Porsche generated record earnings of 28.7 billion euros in the fiscal year 2020 despite the COVID-19 epidemic. Porsche's earnings increased in 2020 as well, reaching nearly 4.4 billion euros. More than 272,000 vehicles were supplied to consumers globally. In total, a 3% decrease from the company's record-breaking year in 2019. Excluding Germany, Porsche's sales in Europe fell by just 4% in 2020 compared to the previous year, whereas Germany, which is Porsche's home market, had a 17% reduction in sales. Porsche's revenue and operating profit both reached new heights in 2021. According to the business, Porsche's revenue jumped by 15% year-over-year to 33.1 billion euros. Operating profit increased to 5.3 billion euros the year before. Porsche was able to raise its sales revenue, operational profit, and return on sales in the first half of 2022, despite a difficult climate for the whole automotive sector. The year has presented the auto industry with a severe task thus far, with supply challenges making it challenging for automakers to produce automobiles. Porsche has yet increased sales revenue by 8.5% to almost $17 billion and operating profit by an astounding 24.6% to $2.7 billion despite this. The return on sales climbed to 19.4% despite the fact that fewer automobiles were delivered in the first half of this year than the first half of the previous year. Applicable financial ratios. Any number greater than 1.0 is a good quick ratio. A quick ratio of 1.0 or higher typically indicates that the company is healthy and able to cover its debts. Porsche has a quick ratio of 1.07. Since this is greater than 1, Porsche has good liquidity. The business is healthy and is able to cover its liabilities. As a general rule, a 10% net profit margin is regarded as average, a 20% margin is considered high, and a 5% margin is low. Porsche has a net profit margin of 12.20%. This goes to show that the business has an above average net profit margin. The net profit margin is a measure of profitability. Since Porsche has an above average net profit margin, this means that the business is making a sufficient profit from sales and its operating costs and overhead costs are under control. Porsche has a debt ratio of 0.55. A debt ratio that is lower than 1 or nearly 0 indicates that a company hasn't used debt to fund its operations. It also indicates that the company has more assets than debt. This is considered relatively safe. A low debt ratio also means that there is financial stability, borrowing capacity, and flexibility. Asset turnover ratio is a measure of revenue earned in relation to total assets. If the ratio is less than 1, it is bad for the business because the total assets cannot generate enough revenue at year's end. However, this will depend on the industry. For example, if the company's ratio is 0.9 and the asset turnover of the industry it belongs to is typically less than 0.5, this goes to show that even though this company has a reduced asset, it is nonetheless performing well. For the auto manufacturing industry, the average asset turnover ratio in 2021 is 0.88. Porsche had an asset turnover ratio of 0.64. This goes to show that the business is not performing well in this area since it is below the industry average. This means that the company is not effectively using its assets to produce sales. The gross margin reveals whether the business sales are enough to pay expenses. For Porsche, the gross margin is 27%. The industry average is 16.38%. This means that Porsche's gross margin ratio is above the industry average. A good gross margin ratio means that the company was able to retain capital, which it can utilize to cover other expenses or pay off debt. As compared to 2020, there is a 1% increase in gross margin in 2021. Businesses can use the operating return on sales ratio to determine how effectively a company can turn sales into operating profit. The company is making money if the ROS is higher than 0.0%. An ROS between 5% and 10% is excellent for the majority of businesses. Porsche has an ROS of 16%. This indicates that Porsche is effectively managing its operating expenses and revenue streams. Additionally, examining historical trends can provide a more accurate prediction of growth. An increasing ROS indicates that the business is expanding productively. There is an increase in ROS in 2021 compared to 2020.
So for part B, do an organization diagnosis using McKinsey 7S model. So for this part, we should define what the McKinsey 7S model is. So the McKinsey 7S model is a tool that analyzes a firm's organizational design by looking at 7 key internal elements: strategy, structure, systems, shared values, style, staff, and skills, in order to identify if they're effectively aligned and allow organizations to achieve its objectives. So the McKinsey 7S model was developed in the 1980s by McKinsey consultants Tom Peters, Robert Waterman, and Julian Phillips, with the help from Richard Pascal and Anthony G. Athos. Since the introduction, the model has been widely used by academics and practitioners and remains one of the most popular strategic planning tools. It sought to present an emphasis on human resources rather than the traditional mass production tangibles of capital, infrastructure, and equipment as a key to higher organizational performance. The goal of the model was to show how 7 elements of the company, the structure, strategy, skills, staff, style, systems, and shared values, can be aligned together to achieve effectiveness in a company. The key point of the model is that all of the 7 areas are interconnected, and a change in one area requires change in the rest of a firm for it to function effectively. So in the screen, you can find the McKinsey model, which represents the connections between 7 areas and divides them into soft S's and hard S's. The shape of the model emphasizes interconnectedness of the elements. Additionally, the model can be applied to many situations and is a valuable tool when organizational design is at question. The most common uses of the framework are to facilitate organizational change, to help implement new strategies, to identify how each area may change in the future, and to facilitate the merger of organizations. For the 7S factors in McKinsey's model, the 7 areas of organization are divided into the soft and hard areas. Strategy, structure, and systems are hard elements that are much easier to identify and manage when compared to soft elements. On the other hand, soft areas, although harder to manage, are the foundation of the organization and are more likely to create a sustained competitive advantage. So for each element, the strategy refers to a well-curated business plan that allows the company to formulate a plan of action to achieve a sustainable competitive advantage reinforced by the company's mission and values. For structure, it represents the way business divisions and units are organized and includes the information of who is accountable to whom. In other words, structure is the organizational chart of the firm. It is also one of the most visible and easy to change elements of the framework. Next, in the hard elements is systems. So systems are the processes and procedures of the company, which reveal business the business's daily activities and how decisions are made. Systems are the area of the firm that determines how business is done, and it should be the main focus for managers during organizational change. So for soft elements, skills. Skills are the abilities that firms' employees perform very well. They also include capabilities and competencies. During organizational change, the question often arises of what skills the company will really need to reinforce its new strategy or new structure. Next is staff. The staff element is concerned with what type and how many employees an organization will need and how they will be recruited, trained, motivated, and rewarded. Next is style. Style represents the way the company is managed by top level managers, how they interact, what actions do they take, and their symbolic value. In other words, it is the management style of the company's leaders. Lastly, for the soft elements are the shared values. So they are the core of the McKinsey 7 model. They are the norms and standards that guide employee behavior and company actions and thus are the foundation of every organization. So in our PPT, we already included Porsche's 7Ss. So what we did was mostly just research online and look at the official website of Porsche and other academic journals found online.
For letter C, it is stated that from the above, we identify the company's major strengths and weaknesses. So, in doing this part of the strama, our group read, understood, and analyzed the information gathered from the revenue or sales in the past 3 years, the applicable financial ratios, and the McKinsey 7S model. From there, we identified the strengths and weaknesses of the company. In identifying the strengths and weaknesses, we look back into our previous discussion about SWOT for us to clearly define strengths and weaknesses and differentiate it from opportunities and threats. The group identified the strengths by looking into the resources, practices, and capabilities of Porsche that can be used by the company to develop a competitive advantage and achieve its objectives. Just to give a brief explanation about the information gathered from Part A and B of this chapter, we have noticed that Porsche's sales revenue increased in the past 3 years. They have good profitability ratios, a high quick ratio, and low debt ratio. They have combined and balanced a decentralized and centralized organization. They have clearly defined systems throughout its 8 departments. Employees are given opportunities to grow, and applicants are screened, hired, and trained based on high qualifications and standards. With that, we were able to identify that Porsche's strengths include its growth in revenue, strong profitability, the good liquidity and leverage ratios, effective organizational structure, clear systems, good corporate culture, and strong staff skills and expertise. The group identified weaknesses by looking into areas, elements, or practices that prevents Porsche from achieving their company goals and objectives. This could be areas where they did not perform well or things that are lacking from the business. From the information gathered from Part A and B of this chapter, we have noticed that Porsche has a low asset turnover ratio. The company has introduced automobiles that are technologically complex or advanced, but have reported issues or problems with quality. Porsche's car maintenance and production incur high costs. Compared to its competitors, they have fewer employees and locations. Lastly, the company has been shifting its brand image. With that, we were able to identify that Porsche's weaknesses include its asset management, unsuccessful product innovation, high maintenance and production costs, few locations and few employees, and brand inconsistency.
Now in this slide, you can see that we use the IFE matrix to evaluate the overall internal strengths and weaknesses of the company, which we based off of Part C, where we also analyzed the strengths and weaknesses of Porsche. Now, as you can see on the table, we have the strengths and weaknesses. We also have the weight, which measures how important it is. And we have the rating, which measures how they were able to respond and if their response was good. And lastly, we have the total score. So as you can see on the strengths, we have growth in revenue, which has a weight of 0.15, which we also rated a 4 and gave off a total of 0.6 in total. Next, we have strong profitability with 0.09, with a rating of 4 as well and a total score of 0.2. We have good liquidity and leverage ratios with a weight of 0.09, rating of 3, and a score of 0.09. We have effective organizational structure with a weight of 0.04, a weighting of 3, and a total of 0.12. clear systems with 0.05 of weight, a rating of 4, and 0.36 in total. We have good corporate culture with a weight of 0.04, a rating of 3, and total 0.12. Lastly, we have strong staff skills and expertise with a weight of 0.03 and a rating of 3, which gives off a total of 0.27. Now, the growth in revenue of Porsche over the past few years has significantly increased from 28.518 billion euros in 2019 to 33.138 billion euros in 2021. Now, this has the strongest impact on the company as well as its strong profitability and good liquidity and leverage ratios. Porsche was also able to successfully utilize its resources to improve the company's strengths. The company was also able to clarify and clearly define systems, which allowed for a better understanding of processes and better control of the activities and responsibilities of every employee, which makes goals easier to achieve. Now, due to Porsche's good corporate culture, it ensures that employees are given the opportunity to grow in their field, making room for a healthy work environment. In addition to that, its effective organizational structure allows for systematic communication between employees and managers, which encourages collaboration and cooperation, which shows trust towards the strong skill set and competitiveness of their employees. Now, for the weaknesses, we can see here that we have asset management with a weight of 0.19, a rating of 3, which gives off a total of 0.30. Unsuccessful product innovation with 0.13. For its weight, we have 3 for its rating and a total of 0.27. We have high maintenance and production costs, which we gave a weight of 0.11, a rating of 1, and 0.13 in total. We also have few locations and few employees with a weight of 0.08, a rating of 3, and a total score of 0.24. And lastly, we have brand inconsistency with a weight of 0.10, a rating of 2, and a total score of 0.22. Now, Porsche has a low asset turnover rate, which means that a lot of their assets go unused. This also indicates that their production capacity is too high compared to the amount of materials produced. Another weakness of the company is their unsuccessful product innovation. Although the latest models have been very advanced in terms of technology, their innovation has compromised the quality of their vehicles. Despite this, the company still continues to adapt to technological advancements at the expense of the vehicle's performance. Porsche's vehicles incur high production costs and high maintenance costs as well, and in return causes the company to operate at high costs. Now, although Porsche focuses on targeting the middle and upper class, they are still yet to expand its vehicles to that require minimal expenses. Now, due to the company's attempt to innovate and expand to other markets, Porsche has now created a problem of brand inconsistency, deviating from their brand image of luxurious sports cars to SUVs and sedans. Lastly, Porsche has fewer locations and employees compared to other competitors, which puts them at a disadvantage. While other car brands are easily accessible, due to the lack of locations and employees, Porsche has become difficult to reach, which also shows the lack of distribution within the company.
So the definition of an IFE matrix. The internal factor evaluation matrix is a strategy tool used to evaluate a firm's internal environment and to reveal its strengths as well as weaknesses. The internal and external factor evaluation matrices have been introduced by Fred R. David in his book Strategic Management. So how do you find the IFE matrix? So you multiply each factor's weight by its rating. This will give you a weighted score for each factor. The last step in constructing the IFE matrix is to sum the weighted scores for each factor. This provides a total weighted score for your business. So in this part, it's essentially more or less the same with the previous matrix and the previous chapter. The only difference is this looks into the internal factors that affects the business. So the strengths and the weaknesses. Whereas for EFE, they talk about the opportunities and threats of a business, which is more of the external. So that's one of the main differences of an EFE matrix and IFE matrix.
For summary and conclusion, we were first tasked to identify the major financial and internal strategic issues that the company must address. So first, for financial, we have a near average net profit margin. Porsche has a net profit margin of 12.2%, which is above the average of 10%. A company like Porsche, however, should maximize their profitability and have a margin closer to a high rating of 20% and further from a margin of with a low rating of 5%. Next, we have a below average asset turnover ratio. Porsche has an asset turnover ratio that is below the industry average, which for a company of their standards should be addressed immediately. As their assets are not turning over enough revenue, Porsche has less access to funding their growth and expansion due to the loss of potential profits. Next, for internal strategic issues, we have a below average vehicle quality. Porsche failed to match the average of 180 in the initial quality study the company participated in. This is alarming because Porsche's consumers and target market are individuals who are paying a premium price and expect nothing but the highest levels of quality in the products they are purchasing. This must be addressed immediately, as these issues may force loyal customers to look elsewhere for alternatives that meet their needs. And lastly, we have brand dilution. With the introduction of the Cayenne, Panamera, Macan, and most recently the Taycan, Porsche now has more four-door SUVs and sedans in their product range than their two-door sports cars. Porsche started as a brand with the distinct image of a two-door sports car, but they continue to expand their lineup, adding other products that may start to dilute the said distinct image they once were so popularly known for. Next, we were tasked to identify key organizational elements that may hinder or promote growth and productivity. For this, we chose strategy. As previously mentioned, Porsche continues to underperform in their net profit margin being near average and asset turnover ratio being below average. This tells us that they are not as profitable as they should be. To address these issues, Porsche may opt to introduce more models such as their most sellable, the Cayenne, in order to make more revenue and in turn more profit. As SUVs require less innovation to produce in contrast to sports cars, this also indirectly addresses their below average vehicle quality because less innovation and technology would simplify their products and in turn make them more reliable. However, if Porsche takes this route, they may further dilute their brand as they will be less known for their sports cars and more known for their other models, which was not in the case in the past. This could decrease the cult-like following Porsche has for their sports cars, as their loyal customers may be pushed away with the introduction of more models that are not what they followed the brand for. Moving forward, Porsche must find the balance between their strategic issues in order to continue growing without hindering the brand's image.